Welcome back to Investing Wizards. I have the pleasure of having JC Parets, who is my first time, two-time guest on the show. This is, I believe you were the first or second guest that about a year and a half ago. Welcome back.
Good to be back. First time that we double up, huh? So we better make it good because the sequel's never as good as the first one.
Sometimes the sequel is as good as the first one.
Godfather, Back to the Future, that might be it.
Back to the Future, definitely. Godfather depends, like, kind of where you fall into it, but yeah. Back to the Future 3, definitely the worst one.
Godfather, same thing, right?
Because they force it all the way at the end.
Back to the Future 3 was better than Godfather 3, though.
Yeah, yeah. But Back to the Future 3, I feel like the plot is the same. And, well, I guess the plot in Godfather
That's the point.
Yeah.
Is that the plot's the same.
Yeah, I guess. Okay. So, JC, I'm gonna open up a little bit about my love for you. I was on Wall Street for 15 years, and I will say that you are probably one of the best. I will not say the best because there's a lot of good. One of the best technicians out there. And the reason is you're consistent, you're straight up, you don't meddle around with all this kind of like crazy hokey pokey. You just look at prices. And also you've nailed all the relevant market calls over the past several years since I've been following you. Maybe you were terrible until then, but you've done a great job the past 5 years since I've started following your work. So if anyone is listening and not following JC, that is a big mistake. Really important to have that input and complement whatever you're doing, whether it's fundamental analysis, macro analysis, whatever it is. And maybe you could just give a quick blurb about All-Star Charts and what you guys do there.
Well, that was very nice of you, Rob. Thank you very much. Listen, I'm not reinventing the wheel here. I'm incredibly fortunate that I lived in New York City for a long, long time, throughout my 20s and early 30s. And I just surrounded myself with some of the smartest people in the world, because if you're in this business of finance or trading or fintech, you're going to make your way to New York one way or another. So for many, many years, it was either like, hey, JC, I'm coming into town, get the crew together, let's go out to dinner. Or it was, hey, JC, so-and-so's in town, we're going to happy hour, we're going out to dinner. So one way or another, I finagled my way to have conversations, many, many, many conversations with really smart people. So most of what you hear me talk about are things I learned from others. In a lot of cases, I remember specifically who and from, where I learned those things. Very little of what you see me talk about is anything that we invented. Sure, we give it a little JC sprinkle and a little all-star chart sprinkle for sure. But, as they say, right, you're standing on the shoulders of giants. All we're doing is just sort of, as the markets evolve, we take those principles and we evolve with it. And people like you, we love people like you because you are helping build the tools for us to be able to go to work that, people, my predecessors didn't have. I mean, they were putting the data by hand, like on the wall and stuff like that. I don't have to do any of that stuff thanks to people like you. So shout to Rob. Because I was fortunate enough to learn so much from so many people, we get to help out hedge funds and banks and individual investors and financial advisors and really anybody who needs to put money to work on a regular basis, which is a lot of people, regardless of your assets under management. They come to All-Star Charts for help identifying trends and looking for trade ideas.
And the thing that I love about your style is kind of like my style or my experience with technical analysis is you start out, you learn about technical analysis and why it's important, why it works. And then you get inundated with all these million indicators that people have, like RSIs and MACDs and Ichimokus, and you just start looking at all of them. And you're like, wow, there's so much stuff here. And then eventually you realize they're all just a derivative of price. And they all just go back to kind of just like price. And that is the thing you look at. And I find that some technicians love to use all the other secondary indicators. And I'm now in my journey where I don't need that. Just show me the price and show me kind of like what the trends and where you think the trend is continuing or consolidating and what the information there is. And I find that in your work, you focus on kind of just the essence of the price and you don't talk about all the other secondary indicators.
Yeah, I mean, listen, price is all that pays. And, regardless of what type of investor you are, you hear it all the time, oh, I'm going to buy XYZ stock or ABC stock. And, so why are you buying it? It's like, well, the CEO this, or, the new drug, or, whatever. There's always a story. There's always a narrative. And all investors are doing all this research without the first step. And when you're doing a research of any stock or commodity or bond, anything you're going to buy, which way is it going? Is it going up or is it going down? Because whatever that answer is, in all likelihood, it's going to continue to do that, right? So like before you go see who the CEO is and what drug they're coming out with or what new product or whatever story you've convinced yourself, the first thing needs to be, is it going up or down, or is it going sideways, right? And if people are like, oh my God, everyone's a bull market, everyone's a genius in a bull market. It's like, no, you're not a genius. You just bought a stock that's going up. So if you just do that more, you're gonna be a genius more often.
Yeah, there's something about like Schadenfreude is something about buying a stock that's going down, or selling or shorting a stock that's going up, and being a little bit contrarian, and then having that knowledge of like all these other people are getting screwed the other way, and you're the only one making money, which is a investment style, but that's well, I guess you could do that.
I think people who think that way don't understand the way that markets work.
Right.
You had a long career in Wall Street, and I did as well. So we understand what moves markets, and it's the money flow from the biggest institutions in the world. And they're going to allocate capital to where their capital is being treated the best. They're going to add to winning positions, and they're going to do the opposite. And if they're losing money over here, they're not going to add to that. That's just not how it works. So things move in trends. And I think once you really understand the way that the market works, it's not because of some news headline this morning or some story. It has nothing to do with that. It's real money flow. And that's happening way before any of those news stories come out. By the time the news comes out, it's already too late. If you were looking at price, you always laugh when the news item comes out. It's like, so that's why copper has been doing so well, or that's why bonds are getting killed.
Yeah, price definitely acts before the fundamentals. Okay, enough of this silly talk about us. Let's get to some charts and some trade ideas. I'm going to share my screen.
Well, why don't we start with bonds? You can't have a real conversation about the stock market without talking about bonds. Would you agree with me on that one there?
It's very important. And do you want to look at the yields or like the TLT?
Yeah, why don't we look at the US 10-year yield, and why don't we look at a 10-year chart, 12, 13-year chart, zoom out to like 2010. There you go. Now you don't have to go to the 80s, but yeah, 2010. There you go.
And so, in your work, hold on a sec. I read your stuff. This is the line you want me to draw, right?
Yeah. And what I like about, Rob just changed the weightings, which I appreciate, because when we use trend lines, we don't want to draw them with sharp pencils. We want to draw them with crayons. Right? Because support and resistance is more of an area. It's a range, right? So that 1.4 level, that was support. That's where yield stopped falling in the summer of 2012. I remember it vividly. We were buying silver at the time. And then in 2016, once again in the summer, the low in yields, right? We saw it again in 2019. And then that broke in Q1 of 2020. And as we were approaching that level, I remember in January and early February, I remember, us in our meetings talking about being like, all right, so if the US 10-year yield is breaking down, right, below all of that support, the bond purists would say resistance, but right, just go with me on this. How is the stock market doing if yields are getting destroyed and completing this massive consolidation lower? So our argument was that stocks are probably not doing that well, and we should be long bonds, right? So that was our trade, just flip the book, long bonds, and then we broke down. So now we got back to the scene of the crime, and it's been messy. But the fact that we're above that 1.4 right now, back above those 2012, 2016 lows, it makes it really hard to be bullish of bonds. And if bonds are selling off and rates are going up, they're probably doing so for a reason. If you take a look at the CRB index or crude oil, or if you want to just take the CRB index and overlay crude oil, take out the 10-year yield and just do like a CRB and crude oil overlaid.
Let's see. I thought we had CRB.
You do. You have it. Why don't you just type in CRB index? Because that's how I find it. CRB index. There it is.
You know our system better than I do.
Come on. Who loves you? Take out the 10-year yield and put oil.
Instead of the 10-year. So let me do this. I'll do CL1. Oops, that's not the right CL1 here. Okay, and I'm gonna just hide this. Okay.
I mean, that's the story. 6-year highs in both.
So let me ask you something. So you're saying, so based kind of like based on this narrative or what we just talked about, oil's going up, commodities are going up, and if you had to gun to your head, you would say that yields are gonna go up as well.
Take a look at the tips versus IEF ratio. So, right. So if, commodities are going up, yields are going up, right? So what's commodities are saying that rates are going higher and pointing towards inflation. So what does the bond market say about inflation? You look at a ratio of tips, TIP,
Mm-hmm.
right? Relative to IEF. This is going to be the 7 to 10 year bond.
Mm-hmm.
That is the bond market's measurement of inflation and what it's pricing in for inflation. And I see, are you adjusting for, is this a total, one of these total return stuff? Because you could just take that element out of this equation if you
let's yep, I'm gonna so it's not gonna be there we go, it's not adjusted.
There we go. So that looks much different.
Okay.
I thought it looked a little slightly off. This is another conversation for another podcast.
Oh, man,
Rob and I are always arguing about whether we should look at technical analysis and do our price analysis based on total return ratios and whatnot, or whether it should be purely based on price and supply and demand. I argue the latter. Rob argues the former, but we're still friends.
Agree to disagree. So basically here, if I look at this, this is kind of like if I had my technical analysis hat on, this is clearly like I would bet this is going up, right?
So if that's the bet that you're making, then you're probably betting on higher oil prices, higher commodities prices, and then when I look at a lot of data, investors are just don't have exposure to commodities. Investors forgot that commodities were an asset class because they've underperformed for so long. But if you look at a ratio of the S&P 500 relative to the CRB index, so do SPX CRB ratio.
And let me just see the ticker here, CRYTR, right? So SPX CRYTR. Great. And just get rid of all these guys. Okay.
So that doesn't look right to me. I'm breaking down to new lows.
You know what? I pulled up the wrong SPX. Just testing you again, JC.
Come on, see, nothing gets past me.
You don't just look at the lines and then create a narrative. See,
I mean, I know what these things look like because I could draw them for you. So if it doesn't look, I'm like, something's off there. Whether it's your dividend adjusted stuff or the wrong S&P 500. It happens to me all the time. Whenever I pull up Deutsche Bank, I get butter futures. Does that ever happen to you?
You're like, I didn't know Deutsche Bank is going up. What is going on?
Yeah, Deutsche Bank I get the butter futures. So funny. Yeah, the New Zealand butter futures, man. On another level.
Tell me what you're seeing here.
Well, it still doesn't look right.
Oh, it didn't. You know what? It didn't pull up the. Let me try it in here. Hold on a sec. SPX, and then in here.
Keeping me on my toes.
CRY. You know what? The relative selection in the series manager is not the best, and even here, it's not pulling up correctly because see, it just keeps doing the. I want this, and then I want CRYTR. Thank you, everyone, for being patient with these technical difficulties. All right. What do you think about that?
There it is. That's the one. That's my baby, breaking down to new lows, like a good downtrend should, right?
Would you really say this is breaking down, though?
Well, you're looking at a 25-year chart, so relax your soul and zoom into what we've seen.
Yeah.
So that spike that you see there, I don't know if you recall, but that was crude oil trading $30 below zero.
So
what better catalyst than that to spark a new commodities super cycle?
So I know you. Well, you do care about composition. You don't care about fundamentals, but you do care about composition. And the composition of this index is what percentage of oil?
It's like over 30% energy.
Yeah. So can we look at something that's non-energy? Like, what would you look at for
So
as?
we do an equally weighted commodities. So it's 33 commodities futures, and we equally weight them.
Yeah.
And in this particular situation, only it ends up being 13% energy in that scenario. And
Hmm.
it looks, honestly, you know what it looks like? It looks like the tips versus IEF ratio.
Hmm.
It looks exactly the same. So if you want to know what our equally weighted commodities index looks like, just look at the tip IEF ratio, and it looks exactly like that.
So if I look at like HG, if I look at copper,
Yep.
and which is like one of the most obviously one of the most cyclically sensitive commodities out there.
Hmm.
Um, this doesn't this looks less bullish. Kind of like would you may I think you had a chart with Freeport in one of your reports, and you were saying, is this a topping pattern or a continuation pattern? And
Yep.
this is a very similar kind of pattern here. And so, but it's not as bullish as energy, which is kind of breaking out to all time highs. So, how do you like? Do you think there's a possibility, and we're kind of like hitting the same level here? Do you think there's a possibility that energy, there's something going on there that's different than some of the other commodities, which are more demand driven, whereas with oil, there's a supply story going on with very large underinvestment taking place over the last 5 years, and
I would
that
say that, but then what you want to do is you want to weigh the evidence, right? And let's take both sides. Be like, all right, let's say it's just oil, and then if you want to look at commodities X energy, then you're getting another number. To me, that would be like going to a restaurant and being like, okay, let's go to a restaurant X, the good food. Let's just get the bad stuff on the menu. The stuff that we're not here for. So to me, it makes less sense to ignore energy, but let's go with it, or oil in particular, because of whatever supply structure situation you speak of, and I've heard some stuff on the news about ships and whatever. So let's just play that game. Then why are coal futures continuing to make new highs? Why is aluminum? You want to talk about copper, whether copper is going to break down or break out. When you look at aluminum continuing to make new highs, you look at tin futures continuing to make new highs while copper consolidates. Why are those other ones continuing higher? Why is aluminum ripping? So to me, when you look at its brothers and sisters and its cousins and what they're doing, they're going higher. And when you look at oil breaking out above 76 and, with the next target up near 100, are you going to make the bet that oil is going to rip to 100 and copper and base metals are going to break down? To me, that's a tough bet to make. Can that happen? Sure. But that's just not the bet that we want to make. We're going to bet that if we're going to be right on oil, copper probably can't be too far behind. So we put on a risk reversal last week in Freeport McMoran, and you can't, I guess technically you can, mathematically, there are more aggressive bets, ways to make a bet, but they don't get much more aggressively bullish than a risk reversal.
yeah, and you guys timed this really well. Was it here that you put it on or here?
It
Because I
was
remember
Wednesday. Yeah,
it was over here.
it was Wednesday morning.
It's pretty good. Um, the other so how do you think about, so let's say weight of the evidence is bullish commodities, but then our friend the dollar, the weight of like what do you see here?
Yeah, no doubt about it, and that's really, the we say it. It's like, oh, it's the missing piece that it doesn't make any sense with our more macro thesis. If commodities were going to keep doing well, why is the dollar so strong? But then you could flip it around and be like, commodities are doing so well despite a strong dollar. So
Mm-hmm.
it's like, which one's gonna give first? The dollar strength has been relentless, no doubt about it, relentless. But the Canadian dollar is up near new multi-month highs, so it's not. If energy is going to go higher, then I think you want to be betting on higher Canadian dollar, right? And we even with the dollar strength, Canadian dollar is not getting killed. Number one. Number two, what about Aussie yen? Aussie yen absolutely exploding. To me, Aussie yen is the same trade as that copper Freeport McMoran sort of situation.
So maybe you could explain to everyone listening why is so Canadian dollar here is exposed to oil. So this will have a very large correlation to oil, and this is dollar CAD, which means if this is going down, the dollar is going out, and the CAD, the Canadian dollar, is strengthening. So this is the Canadian dollar strengthening. Aussie yen. Maybe you could explain like why is Aussie yen important? Why should we look at it?
Yeah, and if you want to invert the Aussie yen there, or invert the dollar Canada, so you can see that they look similar, because just like Canada, you're going to have that natural resource exposure. You're going to have that same exposure in Australia as well. So if commodities are doing well, you should see a relative bid in Aussie and in CAD. But then when you add an element of Japanese yen to the equation, now you're just you're really sparking that fire. You're throwing gas on that fire in terms of risk appetite versus risk aversion in the global markets. Because of the yen carry trade, it gets unwound. So the yen, as the yen is weakening, that is evidence that money is being put to work. You're getting assets allocated towards risk assets as the yen is weakening. But when risk is coming off and the market's in a frenzy and stocks are selling off, you're going to get that bid in Japanese yen. So when you add that element of, super high beta risk on currency like an Aussie, and then denominate that in the more defensive, much more obviously incredibly more defensive yen, you're going to get a good picture of what risk looks like globally. And if you're betting on higher copper prices, higher base metals, you probably need that Aussie yen going higher too.
Well, I didn't realize these two were so correlated. I would have guessed they're a little bit correlated, but obviously it makes sense. Aussie being,
well, because of both numerators, and less, because the dollar is very defensive too. So the numerators are driving these.
So sorry, when you say numerators, you mean CAD and Aussie, or dollar and yen?
Yeah, numerators as in CAD and Aussie, and then whether you're looking at CAD yen or looking at Aussie dollar, like they're all going to look like that.
Yeah. Okay. And I bet most people listening are like, why are we talking about currencies? Let's talk about stocks and talk about equity. So just to kind of like sum up what we just discussed, looking at these kind of macro instruments, which is bonds and commodities, they're at a pretty critical turning point, or pretty critical pivot point in terms of where we are in the reflation trade. But in your view, kind of reading, weighing all the evidence, the weight of the evidence suggests that we're going higher in the reflation trade.
Yeah, I mean, that's so all of these things. Why are we looking at currencies? Why are we looking at interest rates? Why are we looking at all these ratios, commodities? All of that is to put the market, figure out the framework of the current market environment, so that we can then identify. Because let's say you only trade stocks and you don't trade currencies or bonds or any of that stuff. You can't identify which stocks to buy without understanding where we are in the global landscape. So now we know where we are. So now we can say, okay, the reflation trade. So now take a look at 3 ETFs, XLI, XLF, and XLB. So you're looking at industrials, financials, and materials.
So I'm just going to go to this sectors dashboard that we have. I'm just going to pull up, I'm just going to have these, I'm going to uncheck these. So, and then you said I'm going to look at XLI.
Materials, industrials, and financials.
Okay. And just looking at just want to show the performance here year to date. So financials are the best performer, and materials, industrials are sort of in the middle here.
So we'll zoom out on the chart a little bit longer, so you can, not that long. Go back. Yeah, that's fine. Actually, that's perfect. So you can see here, these sectors stopped going up in May.
Yep.
Right? All of these sectors stopped going up in May. And if you punch up, if you include XLE, that one stopped going up in early June. You can add that one if you'd like. So these are the areas of the market that are more value oriented, right? And they stopped going up. Like I said, energy was the last one to peak. So energy was already showing relative strength. So the fact that it's the first one to start doing well, and financials are making new highs, so it's the first two that start doing well. When interest rates are going higher, which are the two sectors that benefit the most from higher interest rates? Energy and financials. And you're already seeing that relative strength. So I think all of that is the same trade. So if you're betting on higher interest rates, higher commodities prices, I think you want to look at energy stocks, and I think you want to look at financials, right? That's where you want to be, not in tech or high growth or any of that stuff, but in the value, cyclical oriented areas.
Mm-hmm. Got it. Okay. So it's basically kind of like this whole period since May has been a consolidation, and we actually want to play the same themes that were happening before May.
Yeah, I mean, the real consolidation really got going in February. In February, emerging markets peaked. In February, the IPO index peaked. So like you could throw up a chart where it's EEM, IPO. So you could throw EEM, which is emerging markets, and then you could throw just go back to leave it right just like that. So you got EEM, you got IPO. So this is the IPO index. You got biotechnology, XBI. So XBI also peaked in February.
Because I know we don't have that index.
So you got all of these. Important areas of the market all peaking. The Nasdaq new 52-week highs list also peaked in February. The Nasdaq advanced decline line peaked in February. So that, if you recall, that's like the SPAC crazy. Everybody had a SPAC. Rob has a SPAC. JC has a SPAC. SPACs for everybody in February. Remember?
I never had a SPAC, JC. I'm not cool or wealthy enough to have a SPAC.
You're not like SPAC Linsen over there.
not like SPAC. One day, aspiring.
Dude, you and me, we could do like a charting, right?
Yeah,
like a charting SPAC.
Yeah, I think we call it data visualization SPAC to get a better valuation.
Yeah, data visualization SPAC. I like that sound. It sounds way better. Charting SPAC.
So basically, if you kind of take that framework and you think about February as being a turning point, none of these risk indicators that turned in February are acting well. How do you think about that?
Right. So I think my bigger point here is that when people are like, "Oh, our stock's going to correct," I think the answer is that stocks have been correcting since February, and we are now in October. So if you look at the IWM and the IWC, those are small caps and micro caps, you could see that they stopped going up in February. They made like a slightly higher high in March that quickly failed. But essentially, the breadth in general peaked in February. If you look at the value line index, which measures the median stock change, it also stopped going up in February. So for the most part, these indexes, stocks in general, just haven't done well for the majority of the year. And if you want to clear all this out and just go look at the S&P 500, go back to the S&P 500, just first of all, show it recently what it just did off of last year's March lows. Right? So just like zoom out a little bit just so you could really get a perspective as to what it did. So monster move, right? So look at that. Just keep that in mind, that monster low in March and then the face ripper after that, right? Major, major, major move, right? Now, go back to 2009.
I didn't realize we're up almost exactly 100% since the bottom. Kind of interesting. 2009. Yes, sir.
2009 looks exactly like that last year, 2020 low to the recent highs. But then look what happened in 2010. That was just a messy market, right? Messy market off those lows. Now go back to 2003. Look at that. Look at the low off the 2003, that initial thrust. And then look at the end of 03 and into 04. Kind of pretty messy market, right? Consolidating those gains.
So I love this framework of kind of like bouncing up and then moving higher after that. And consolidation here was pretty small or not that violent and moved up. You were in the market here, right? You were. So 2010 was just like a face ripper for everyone, because just as everyone got comfortable, you had May 6th, which was the huge sell-off. No one understood it, and this was like a really bad time for people and lost a lot of money. So this kind of framework of like 1 year up and then the next year being a consolidation is a really interesting way to think about it and where we are in the cycle. If we think about it that way and we include 10-year yields here, right, and I'll just put this on different.
Because yields peaked what, in May?
That's exactly what I'm going to get at is 2003, you had a similar kind of thing that yields popped and then they didn't really move anywhere, right? So here kind of like they made a new high and didn't really go anywhere. In 2009, similar thing. This is where they peaked and then they sort of moved sideways and then lower. And then we're here, right? So if you're using this 1 year or second year framework, could be an argument that like this is kind of the peak, that we've already had that growth impetus or that reflation impetus, and going forward, it's just going to be a pretty slow, steady, either sideways or downward yield, similar to what we had before.
And then not to mention that we've seen a sentiment reset, right? So half the stocks in the Nasdaq are down over 20%, and another close to 25% of those Nasdaq stocks are down over 50%, just this year alone. So we've seen, the average New York Stock Exchange stock is down over 20%. So we have seen a stealth correction underneath the surface that the majority of industry groups and individual stocks and particularly countries around the world have been correcting for most of the year. So I think that sets the stage for, a bull market for years to come in equities.
Okay. And so obviously as a technician, you always want to be long the strongest names on a relative and absolute basis. What are the strongest area of the market, kind of either in the US on a sector basis, on a country basis? What are you looking at as kind of like pockets of the market, pockets of the equity market that are showing really nice relative strength?
Yeah, it's got to be the energy and financials, right? So if you look at EQRR is an ETF that consists of stocks. It's called the Rising Rates ETF. So these are stocks that should do well in a rising rate environment. And then when you look at the components, half the components are financials and energy, right? So this is definitely an area that we want to look at. If you look at KRE, for example, that those are your regional bank stocks, right? So it's going to look a lot like that. So those are areas that I think that we want to be focused on. When you look at the FRAC ETF, FRAK. This is an ETF that is being delisted on Friday. So you want to look at the components of what's in there. The ETF companies have an uncanny ability to delist ETFs just when the investors need them the most. And here we're making new 6-year. If you look at a ratio of FRAC relative to XLE, we're making new 6-year highs in terms of FRAC. So FRAC is the unconventional oil and gas ETF. So you're going to have names like Marathon, Occidental Petroleum. If I were you, I would take a look at those components, memorize them, because it's not going to be around much longer. It actually tracks the MVISA Global Unconventional Oil and Gas Index. So the indexes, I don't think is going to disappear, but the ETF most certainly is. So when you look at the components, you're looking at ConocoPhillips, EOG, Pioneer, Hess, Oxy, Devon, Diamondback Energy. So, for me, those are the names that we want to be focused on. And remember, they're much smaller names. Conoco is really the only monster there. EOG a little bit, but these are smaller names in general because these energy stocks got slaughtered. So it's not like you're buying a $2 trillion tech company. You're buying a $3 billion oil services company. Whatever, explorer, right? Producer.
And any view on nat gas versus oil?
Natural gas was a messy start, when it was under 2, we were bullish because this is where natural gas had always found support. Like if you really zoom out, you'll see that under 2 area, that's traditionally like when you really go back, like those are areas where you want to be looking to buy, right? As you can see historically. So the trade was to be long if it's above 2. Like I said, it was a messy start, but it got it done. Our target was around 5, get back to those highs, and our targets were hit. So it's just a much tougher trade up here. It's just, it's not for me. If anything, you want to look at the natural gas stocks. So FCG is the ETF there of natural gas stocks. So it's probably a good place to start, and then you can look at the components of FCG.
That's pretty, that's incredible. So it's 6x off the lows. Just pull up the components here using our favorite HDS function. Use this function, right?
Yeah.
Got it. Okay. So basically risk reward and nat gas a little bit more balanced. And
yeah, I like the stocks. I mean, listen, if you're trading natural gas futures, God bless you. I mean, it's the widowmaker for a reason, right?
Yeah. Yeah. Especially selling calls on it.
Right. Thank you. You have to make videos crying after you. Stampeded over.
What year was that? That was what, 2016,
I
15?
don't know, man. That's the type of content I'm here for.
Just random fact. I think I think that was this
Looks about right. Good
2018.
times.
2018. What about India?
Listen, you want to talk about relative strength? Geez Louise, Nifty 50, new all-time highs. You look at Bank Nifty, new all-time highs. HSBC, not HSBC, HBDC, right? So I think it's HBD is the ADR.
Yeah, we have all the local shares here. So if
Or
I'm just,
HDF, sorry, is it HDF? What's the, there's an ADR. It's an HD.
let's see, we could click on here, go to
It's HDB. It's HDFC Bank. That's an interesting one. A lot of relative strength over there. You know, Reliance doesn't have. You have Reliance, but in India, look at that Reliance.
I'm just going to pull up the EPI here, the EPI ETF into lots of charts, and just get a quick overview of some of these 9 charts. And let's
this stock represents half their energy index. This is half of Nifty Energy is Reliance.
So this is So and we want to let's go on a 5-year basis.
ICICI Bank, Kotak, Bajaj Finance. Oh yeah.
These
GCS.
are all in really nice uptrends, huh?
Where's Reliance? Reliance should be popping up. Reliance is a big component.
It's first one.
Oh, there it is. Oh, yeah, duh. I'm like, Reliance is a pretty big company over there. Yeah, what a beast, right?
Yeah, wow. It's a pretty steady uptrend.
Yeah.
Cool. So I was looking at some of these like uranium names the other day.
Yeah, sure.
How do you, oh wow, it's a good day today. How do you, like, as a technician, right, as just looking at the technicals, how do you trade something like this that has like a pretty massive breakout in volume and then consolidates, kind of like has this super big drawdown? How do you know, like, if you have to weather like a 20% drawdown in 2 weeks, if you're still long this trend? Like, how do you trade this from a technical perspective and a risk perspective?
Well, I think that you just need to identify your time horizon and your risk parameters, and you really want to just stick with that. For us, our upside objectives were above 25. Those were that former resistance from 2012 and 2014, right? So the breakout out of that base down near 12, 13 bucks, right? The breakout out of that base gave us a target up above 25. In terms of trading it now, it's not really anything we're focused on because we're still below all that overhead supply. So for us, it was really mission accomplished. We had a good entry because, I mean, me, I love a good base. And that base above 12, 13 bucks doesn't get any cleaner, not to mention the whipsaw. So the breakdown last year below those 2016 lows.
You're talking about right here, or?
No. The breakdown last year.
Oh, right here. Oh, got it.
Below those 2016 lows, which are right around 7 and change.
Yeah.
If you want to you're looking at URA, but I was looking at CCJ, but yeah, you're going to get a very similar picture.
Okay, so let me just pull that up.
Yeah, put up CCJ. Sorry, because the y-axis is actually very similar between CCJ and URA. So this is CCJ. So URA is an ETF of uranium, but CCJ is like the bellwether there. It's like saying Newmont for gold miners or Exxon for energy.
And so basically your overhead is sort of like now you're looking at it around
25 and a half, 25 and change. That's it. Mission accomplished.
Got it.
Yep. So now that needs to be our floor. So for a long to make sense to us, that we got to be above that. And we just got here. So, who knows how long that's going to take to really get going.
Got it. So still kind of, this is interesting to you, but you wanted to go above this pivot point, keep above the pivot point, and then it would make sense as a long here.
Yeah, I mean, I'm really not in any rush to get back in. There was definitely a much easier entry point that we saw, and we're just not there. The risk versus reward is no longer what it once was. Just like crude oil, when crude oil hit 76 a couple months back, there was no reason to be in crude because now we're just stuck in a range between 6.6 and 7.6, And then the trade has only been since then to be long if oil's above 76. Last week we got above 76, so now we got that trigger. Who knows? You know, we've been waiting for gold to get back above 2,000 for over a year. Who knows how long that's going to take? If
Yeah.
we were in a rush, you know, in gold, we would have been sitting in that garbage this entire time, right? So this is no different. I don't. Maybe uranium breaks out next week. I have no idea. But if gold has taught us anything, is that patience is really really important in this business.
Yeah, absolutely. Cool. Awesome. Well, thanks so much, GC. This has been really helpful to walk through your thoughts. A lot of kind of cross currents in the market. So great to get your download and your view of things. Appreciate your time.
Yeah, man. Anytime. You know that.
Cool. All right. Talk to you soon.
All right, Rob.